Welcome traders to the Prophetic Analysis Masterclass. Today, we embark on a journey that cuts to the very core of what it means to succeed in the financial markets. Many believe that trading is a battle against the charts, a constant struggle to outsmart the system and predict every move. They spend countless hours searching for the perfect indicator, the one secret algorithm that will unlock endless profits. They see the market as an external enemy, a complex puzzle that must be solved. This relentless pursuit often leads to frustration, anxiety, and ultimately failure. It's a common misconception that keeps so many talented individuals from reaching their true potential in this challenging field. But what if I told you the real battle isn't out there in the noise of the ticker tape? What if the greatest challenge and the greatest opportunity lies within you? The truth is, trading isn't about beating the market, it's about mastering yourself. It is about conquering the internal forces of fear and greed that cloud our judgment and lead to impulsive decisions. The market simply is what it is, a reflection of collective human psychology. It presents opportunities, but it is our own internal state that determines whether we can capitalize on them consistently. This paradigm shift is the first and most crucial step towards sustainable success. Consider this. The market doesn't know you exist. It doesn't care about your positions, your hopes, or your fears. It will move according to its own dynamics, indifferent to your personal outcome. The only variable you have complete control over is yourself. You control your entries, your exits, your position sizes, and most importantly, your reactions to wins and losses. This is where the real work begins. It's about building a framework of discipline, a fortress of mental resilience that can withstand the market's inherent uncertainty. True trading mastery is an internal game, a journey of self-discovery and unwavering self-control. This masterclass is designed to guide you through that internal journey. We won't be giving you a magic formula or a holy grail system. Instead, we will equip you with something far more powerful, a deep understanding of risk management and the psychological fortitude to apply it. We will explore the principles that separate the consistently profitable traders from the crowd. It's about transforming your mindset from one of a gambler hoping for a big win to that of a professional risk manager, methodically protecting capital and executing a well-defined plan. This is the path to longevity and true freedom in trading. So, what does this journey of self-mastery look like? Over the course of this masterclass, we will build a comprehensive framework for trading risk management piece by piece. We will start by diving deep into the psychology of risk, understanding how our minds are wired to react to uncertainty, and why emotional discipline is your greatest asset. We will uncover the hidden mental traps that cause traders to self-sabotage, even when they know what they should be doing. From there, we will lay the foundational stones of practical risk control, starting with the critical skill of position sizing. This isn't just about numbers, it's about survival. Next, we will tackle one of the most essential tools in any trader's arsenal, the stop loss. We will demystify its purpose, showing you how to set it not just as a defensive tool, but as a strategic component that defines your risk before you ever enter a trade. We'll move on to the core challenge of managing emotions, learning to recognize the subtle whispers of fear and the intoxicating pull of greed. You will learn practical techniques to remain calm and objective, making decisions from a place of logic and clarity, not emotional chaos. This is where consistency is born, in the quiet moments of disciplined execution. The journey continues as we explore the incredible power of compounding. We will illustrate how small, consistent gains, protected by smart risk management, can grow into substantial wealth over time. This is not a get-rich-quick scheme, it is a get-wealthy sustainably strategy. To support this growth, we will introduce the indispensable practice of journaling your trades. This is your personal feedback loop, a mirror that reflects your trading habits, helping you identify patterns, learn from mistakes, and systematically improve your performance. It transforms every trade, win or lose, into a valuable lesson for the future. Finally, we'll discuss adaptation and the crucial importance of a growth mindset. The markets are dynamic, constantly evolving entities, and your strategies must evolve with them. We will teach you how to stay flexible, how to learn continuously, and how to bounce back from the inevitable setbacks with resilience and determination. This entire masterclass is your roadmap. It is a structured path designed to transform you from a market participant into a market professional. Join us. Let's shape a new way forward, together.
Together.
Let's begin by exploring the very architecture of our minds. Our brains are not naturally wired for the modern financial markets. They are ancient survival machines, finely tuned over millennia to respond to immediate physical threats and opportunities in the wild. When our ancestors faced a predator, their fight or flight response kicked in instantly, flooding their systems with adrenaline and cortisol. This primal reaction was essential for survival, enabling quick, instinctive decisions without the luxury of careful analysis. This same powerful, deeply ingrained wiring is still active within us today, and it profoundly impacts how we perceive and react to financial risk, which is a modern, abstract form of threat. The market's inherent uncertainty triggers this same primal response. A rapidly falling price on a chart can feel to our subconscious mind like a predator lunging from the bushes. The potential for loss is perceived not just as a financial setback but as a genuine threat to our well-being and security. This triggers a cascade of physiological and emotional reactions. Your heart rate might increase, your palms might sweat, your thinking becomes narrow and short-term, focused solely on escaping the immediate discomfort. This is your survival instinct at work, but in the context of trading, it often leads to the worst possible decisions, like panic selling at the bottom or hesitating to take a valid signal. Understanding this biological reality is the first step toward gaining control. You are not weak or flawed for feeling fear when a trade moves against you, you are simply human. The problem is that these automatic emotional responses are the polar opposite of what is required for successful trading. Trading demands logic, patience, and adherence to a predefined plan, even when every fiber of your being is screaming at you to do something else. The challenge, therefore, is not to eliminate these feelings. That's impossible. But to recognize them for what they are, outdated survival signals that are not suited for the environment of the financial markets. This is why self-discipline is not just a helpful trait for a trader, it is the absolute foundation of long-term success. It is the conscious effort to override your primal instincts with a higher-level, logical framework. It involves creating a set of rules, your trading plan, when you are calm and rational, and then having the fortitude to follow those rules when the market pressure is on and your emotions are running high. This chapter is about building that mental fortress. It's about learning to observe your internal reactions without being controlled by them, allowing your logical mind to remain in the driver's seat, navigating the markets with clarity and purpose. Within this landscape of primal responses, two specific emotions stand out as the primary destroyers of trading accounts: fear and greed. These are the twin demons that every trader must confront on a daily basis. They are two sides of the same coin, both stemming from an attachment to the outcome of a single trade, rather than a focus on the process. Fear can paralyze you, causing you to miss out on perfectly good opportunities. It can make you exit a winning trade prematurely, grabbing a tiny profit just to avoid the anxiety of watching it fluctuate. It is the little voice that whispers, "What if you're wrong?" and convinces you to abandon your well-researched strategy. Greed, on the other hand, is the intoxicating siren call of easy money. It pushes you to take on excessive risk, hoping for that one life-changing trade. It convinces you to hold on to a winning position for far too long, watching it turn from a solid gain into a heartbreaking loss. Greed is what makes you double down on a losing trade, stubbornly believing it has to turn around. It's the feeling that drives you to overtrade, jumping into setups that don't meet your criteria simply because you can't stand to be on the sidelines. Both fear and greed hijack your decision-making process, replacing disciplined strategy with impulsive, emotionally driven actions that almost always lead to ruin. The insidious nature of these emotions is that they often feel justified in the moment. When you are afraid, your mind will construct elaborate reasons why exiting a trade is the smart thing to do, even if it violates your plan. When you are greedy, you will tell yourself that this opportunity is too good to pass up, ignoring all the red flags your logical mind might be waving. This is self-sabotage in its purest form. You know the rules, you have the strategy, but, in the heat of the moment, your emotional brain takes over and convinces you to break them. The market then provides a painful but immediate feedback loop, reinforcing the negative cycle. The only way to conquer these two demons is to starve them of their power. Their power comes from your focus on the outcome of any individual trade. By shifting your focus to the flawless execution of your process over a series of trades, you begin to neutralize their influence. Your job is not to make money on this one trade. Your job is to follow your rules perfectly on this one trade. When you adopt this mindset, wins and losses become mere data points in a larger campaign. A loss is no longer a personal failure to be feared, and a win is no longer an ego boost to be chased. They are simply outcomes of a well-executed probabilistic strategy. So, how do we move from understanding these psychological flaws to actually overcoming them? The answer lies in forging unwavering discipline through deliberate practice. Discipline is not a personality trait you are born with. It is a muscle that you build over time through conscious, repetitive effort. It starts with creating a trading plan that is so clear, so objective, and so detailed that there is no room for ambiguity when you are in a live trade. Your plan must explicitly define what constitutes a valid entry, where your stop loss will be placed, and what your profit targets are. This plan is your contract with yourself, written in a state of calm objectivity. Once you have this plan, the real work begins, the practice of perfect execution. This means committing to follow your rules on every single trade, without exception. The outcome of the trade is irrelevant. A trade where you followed your rules and lost is a successful trade. A trade where you broke your rules and won is a failure, because it reinforces bad habits that will eventually lead to disaster. This concept is often difficult for new traders to accept, as they are so focused on the immediate profit and loss. But professional traders understand that their edge comes not from being right every time, but from being disciplined every time. This process of building discipline requires a framework of accountability. This is where a trading journal becomes your most critical tool, something we will cover in a later chapter. A journal forces you to confront your actions honestly. At the end of each day, you must look back and answer a simple question. Did I follow my plan? There is nowhere to hide. This practice of self-review shines a bright light on your emotional decision-making, making you painfully aware of every time fear or greed caused you to deviate. Over time, this awareness builds a powerful feedback loop that strengthens your resolve to stick to the plan, as you see the direct correlation between discipline and stable results. Ultimately, forging discipline is about creating an environment where your logical self can thrive. It involves pre-committing to your actions before the market opens and your emotions are engaged. It means accepting that you cannot control the market, but you can, with absolute certainty, control your own behavior. This is the profound shift from being a gambler, reacting to the market's every whim, to being a professional risk manager, executing a statistical edge. This journey is challenging. It requires patience and a commitment to self-mastery, but it is the only path to achieving consistent profitability and true freedom in your trading career. Now that we understand the psychological battlefield, let's arm ourselves with our first practical weapon: proper position sizing. This isn't just a detail, it is the absolute cornerstone of survival in the trading world. Before you even think about where to enter or exit, you must first answer the most important question. How much can I afford to lose on this single idea? Get this wrong, and even the world's best trading strategy will eventually lead you to ruin. The secret is surprisingly simple, yet profoundly powerful. It's a rule that protects you from the one event that can end your career, a catastrophic loss. You must never risk more than a small, predetermined percentage of your trading capital on any single trade. This golden rule, often called the 1% or 2% rule, is your ultimate defense mechanism. It ensures that no single trade, no matter how disastrous, can significantly harm your account. Think about it. If you risk only 1% of your capital, you would need to suffer 100 consecutive losses to wipe out your account. An event that is statistically almost impossible for any strategy with even a semblance of an edge. This approach immediately shifts your focus from hoping for a huge win to ensuring your own longevity. It is the mindset of a casino, which knows it will lose on individual hands but will win over time because it has a small statistical edge and manages its risk flawlessly on every single bet. Many new traders ignore this fundamental principle. Driven by greed, they place trades that risk 10%, 20%, or even 50% of their account, hoping for a quick, life-changing profit. This is not trading, it is gambling. A single unexpected market event, a sudden reversal, or a moment of bad luck can wipe them out completely. They are operating without a safety net. By committing to risk only a tiny fraction of your capital, you give yourself the most valuable asset a trader can have, the ability to stay in the game. You grant yourself the mathematical certainty that you will survive to trade another day, another week, and another year, allowing your edge to play out over time. This rule also has a profound psychological benefit. When you know that the absolute most you can lose on a trade is a small, manageable amount, it dramatically reduces the emotional pressure. The fear that we discussed in the last chapter loses much of its power. You can watch the trade unfold with greater objectivity because the outcome of this one instance is not critical to your survival. It frees your mind to focus on executing your strategy correctly, rather than being consumed by anxiety about the potential loss. This is the first practical step in separating your emotions from your trading decisions, creating a foundation of calm and control. So, how do we translate this golden rule into a concrete action? How do we go from a percentage to knowing exactly how many shares or contracts to buy? It's a simple two-step calculation that you must perform before every single trade. First, you determine your maximum risk in dollar terms. Second, you use your trade-specific risk, the distance to your stop loss, to calculate your exact position size. This mechanical process removes all guesswork and emotion from the decision. It ensures that your risk is consistent and controlled, regardless of the asset you are trading or the volatility of the market. It is the engine of disciplined risk management. Let's walk through the first step. You take your total trading capital and multiply it by your chosen risk percentage. For example, if you have a $20,000 account and you follow the 1% rule, your maximum allowable risk per trade is $200. That's it. This number, $200, is your line in the sand. It is the absolute maximum you are permitted to lose if this trade goes completely wrong and hits your stop loss. This number should be non-negotiable. It is your budget for this trade idea. You must know this figure before you even look at a chart, as it anchors your entire decision-making process in the reality of your account size and risk tolerance. The second step connects this dollar risk to your specific trade setup. Before you enter any trade, you must know exactly where your protective stop loss will be placed. This defines your per share or per contract risk. Let's say you want to buy a stock trading at $50, and your analysis tells you that your stop loss should be at $48. Your risk per share is the difference, which is $2. Now you simply divide your maximum dollar risk, $200 from step 1, by your per share risk, which is $2. The result is 100 shares. This is your correct position size. By buying 100 shares, you ensure that if the trade fails and hits your $48 stop loss, your total loss will be exactly $200, or 1% of your capital. This two-step process must become an unbreakable habit, a pre-flight checklist you run before every single trade. It automatically adjusts your position size based on the volatility and specifics of each setup. For a trade with a tight stop loss, it will allow you to take a larger position. For a trade that requires a wider stop, it will force you to take a smaller position. In every single case, however, your total potential loss remains the same. That fixed $200. This is the secret to consistency. You are no longer randomly picking a number of shares to buy. You are scientifically calculating the precise size that aligns with your overarching risk management framework. While the 1% or 2% rule provides a fantastic mathematical starting point, true mastery of position sizing goes one step further. It involves customizing that rule to fit your personal psychological tolerance for risk. For some traders, particularly those new to the markets or with a very low-risk nature, even a 1% loss can feel jarring and emotionally disruptive. It might cause them to second-guess their strategy or even interfere with their sleep. If this is the case, then 1% is just too high for you, regardless of what the math says. The goal is not just to survive mathematically, but to really thrive psychologically. You must operate at a level where losses are merely a business expense, not a source of emotional pain. Think of it as finding your sleep at night number. This is the amount of money you can have at risk in the market, and still go about your day without constantly checking your positions, feeling anxious or being distracted. For one person, that might be 1%. For another, it might be 0.5% or even 0.25% of their capital. There is no shame in risking less. In fact, it's a sign of wisdom and self-awareness. Trading with a position size that is too large for your emotional comfort is a recipe for disaster. It will inevitably lead you to make fear-based decisions like exiting a good trade too early just to stop the mental discomfort of the drawdown. To find your personal number, you may need to experiment. Start with a very small risk, like 0.5% per trade, and see how you feel. Pay close attention to your emotional state during a trade, especially a losing one. Did it cause you significant stress? Did the loss linger in your mind and affect your next trading decision? If so, your size is still too large. Keep reducing it until you find a level where a loss is truly insignificant. A level where you can accept it calmly, log it in your journal, and move on to the next opportunity with a clear and objective mind. This is your personal risk threshold, and respecting it is paramount for long-term consistency. Ultimately, the perfect position size is one that keeps you in the game both financially and mentally. It must be small enough to ensure your capital is protected from a string of losses, but also small enough that it doesn't trigger your internal demons of fear and greed. By aligning your mathematical risk with your psychological tolerance, you create a state of harmony in your trading. You build a framework that allows you to operate at your peak, executing your strategy with the calm, detached confidence of a true professional. This isn't just a secret to managing risk, it's a secret to managing yourself. Let's now turn our attention to one of the most misunderstood, yet absolutely critical tools in trading, the stop loss. A stop loss is a predetermined order you place with your broker to exit a trade at a specific price, limiting your loss on that position. It is not an optional accessory or a sign of weakness. It's your non-negotiable insurance policy against catastrophe. Many novice traders resist using them. They believe that a stop loss is an invitation to get knocked out of a trade that might eventually turn around in their favor. This thinking is flawed because it's rooted in hope, not strategy. Hope is not a viable plan when your hard-earned capital is on the line. The primary purpose of a stop loss is to protect you from the unexpected. Imagine driving a car without brakes. You might be fine for a while on a straight, empty road, but the moment an obstacle appears, disaster is inevitable. A stop loss is your brake pedal in the market. It's the mechanism that allows you to navigate the twists and turns with a degree of safety. Its function is to definitively answer the question, at what point is my original trade idea proven wrong? By setting a stop loss before you even enter a trade, you're making a rational, objective decision about your maximum pain threshold, free from the emotional turmoil of a losing position. It transforms a vague hope into a concrete plan with a defined and limited risk. The market is an environment of probabilities, not certainties. No matter how perfect your analysis is, any trade can fail. A surprise news event, a sudden shift in sentiment, or just the random chaos of the market can turn a winning setup into a losing one in an instant. Without a stop loss, a small, manageable loss can quickly spiral into a devastating one. You might find yourself frozen, watching the red numbers on your screen grow larger, paralyzed by the hope that it will reverse. A hard stop loss removes this dangerous emotional variable from the equation. It executes automatically, protecting your capital from your own worst enemy, your emotional, hoping self. Therefore, you must make a pact with yourself today. You will never, ever enter a trade without knowing exactly where your stop loss will be placed. And once it is set, you will never widen it to accommodate a losing position. Moving your stop further away because a trade is going against you is like disabling the brakes on your car while heading downhill. It is the single fastest way to blow up a trading account. The stop loss is your line in the sand, drawn when you are calm and objective. Your job in the heat of the moment is to respect that line. It is your ultimate commitment to disciplined risk management and professional trading. Knowing you need a stop loss is the first step, but knowing where to place it is what separates amateurs from professionals. A properly placed stop loss is not based on an arbitrary number or a random percentage that just feels comfortable. It's not about risking a fixed amount like 50 cents on every trade. Instead, its placement must be dictated by the market's own structure and the logic of your trade setup. It should be placed at a logical price level that, if breached, would invalidate the original reason for taking the trade. This makes your exit a strategic decision based on technical analysis, not an emotional reaction to financial pain. For example, if you're buying a stock because it has bounced off a strong support level, your stop loss should be placed just below that support. If the price breaks through that key level, the entire premise of your trade, that the support would hold, is proven wrong. There is just no logical reason to remain in the position any longer. Similarly, if you're trading a breakout above a resistance level, your stop might be placed just back inside the previous trading range. A move back below that breakout point suggests that the initial momentum has failed. The market itself is telling you that your idea was incorrect, and it's time to exit gracefully and preserve your capital for the next opportunity. This approach requires you to analyze the chart and identify these key technical levels before you ever think about clicking the buy button. Look for significant swing lows or swing highs, major trend lines, or important moving averages that provide a logical point of invalidation. Placing your stop loss based on this market structure accomplishes two things. First, it gives your trade enough room to breathe and withstand the normal, random fluctuations of the market without getting stopped out prematurely. Second, it ensures that your risk on every trade is tailored to the specific conditions of that setup, which is a far more intelligent approach than using a one-size-fits-all percentage stop. Remember the position sizing calculation from our last chapter? This is where it all comes together. First, you identify the logical stop-loss placement based on the chart structure. This tells you your per-share risk. Then you use that per-share risk to calculate the correct position size that keeps your total dollar risk within your 1% rule. This two-step dance ensures that your risk is always controlled in dollar terms, while your stop-loss placement is always logical in technical terms. This synergy between strategic stop placement and disciplined position sizing is the engine of a truly professional risk management system. It's how you stay in the game long enough to win. Even with a perfectly placed stop loss and a correctly calculated position size, the moment your stop is hit can be emotionally challenging. No one likes to lose. Hitting a stop loss can feel like a failure, a confirmation that you were wrong. This is where a critical psychological shift must occur. You must learn to view a triggered stop loss, not as a personal failure, but as a successful execution of your risk management plan. It's actually a sign that your system is working as intended. The stop loss did its job perfectly. It protected you from a potentially much larger loss, preserving your precious capital so you can fight another day. Think of it as a business expense. A bakery owner does not see the cost of flour as a failure. They see it as a necessary expense to produce the bread that generates profit. In the same way, small, controlled losses from your stop-loss orders are the cost of doing business in the financial markets. They are the necessary and expected price you pay for the opportunity to capture much larger winning trades. When you truly internalize this concept, the emotional sting of a loss begins to fade. It is no longer an attack on your ego or your intelligence. It is simply a data point, a calculated cost within your overall business strategy. This reframing is essential for maintaining your mental equilibrium. If you view every stopped-out trade as a painful defeat, you will begin to develop a fear of losing. This fear can lead to hesitation, causing you to miss valid trade signals. Or worse, it might tempt you to start widening your stops to avoid the pain of being wrong. By celebrating a stop loss as a successful action, a win for your discipline, you reinforce positive trading habits. You are rewarding yourself for following your rules, which is the only behavior you have complete control over and the true key to long-term consistency in this challenging profession. Ultimately, mastering the stop loss is about mastering the art of acceptance. It is about accepting that you cannot be right every time. It is about accepting that losses are an integral and unavoidable part of the trading process. When you can accept a loss without an emotional reaction, you have achieved a level of professional detachment that is rare among traders. Your stop loss is not your enemy, it is your greatest ally. It is the silent guardian of your trading account, the tool that ensures your survival, and the mechanism that allows you to operate with discipline and confidence in the face of uncertainty. Embrace it, respect it, and it will serve you well. We have built our defenses with position sizing and stop losses. Now we must confront the enemy within. This is the most challenging part of the journey. Managing emotions is the final frontier of trading mastery. You can have the best strategy in the world, but if you cannot control your inner state, you will inevitably sabotage your own success. The two primary forces we must contend with are the familiar demons of fear and greed. They are not just abstract concepts, they are tangible feelings that arise during live trading, clouding our judgment and compelling us to act against our own best interests. Recognizing them is the first step to disarming them. Fear is a powerful, paralyzing force in trading. It appears in many disguises. It is the hesitation that stops you from taking a perfect setup because your last trade was a loss. It is the anxiety that makes you snatch a small profit from a winning trade, terrified it will turn against you, only to watch it run for a huge gain without you. Fear is also what causes you to panic sell at the very bottom of a pullback, right before the market reverses. This fear stems from an inability to accept risk. Even though you have a stop loss and a small position size, your mind magnifies the potential for loss into an unbearable threat, triggering that primal fight-or-flight response we discussed earlier. Greed is the opposite side of this emotional coin, but it is just as destructive. Greed is the intoxicating rush you feel after a big win, making you believe you have a special insight into the market. It pushes you to abandon your rules and take on oversized positions, hoping to repeat that success quickly. Greed is what convinces you to chase a stock that is already moving fast, entering late at a terrible price. It is the stubborn hope that makes you hold on to a winning trade for far too long, ignoring your profit targets, only to watch all your gains evaporate. Greed makes you overtrade, seeing setups that are not really there because you cannot stand the thought of missing out on a potential move. These emotions are not your fault, they are part of our human makeup. The problem is that they are driven by a focus on the outcome of a single event. Both fear and greed are rooted in an intense desire to either avoid the pain of a loss or capture the pleasure of a win on this specific trade. This is a gambler's mindset. The professional trader, however, understands that the outcome of any single trade is random and meaningless. Their focus is not on the immediate result, but on the flawless execution of their process over a large series of trades. By learning to recognize the first signs of fear and greed, you can consciously choose to shift your focus back to what truly matters: your discipline. Recognizing fear and greed is one thing. Preventing them from controlling your actions is another. This requires a toolkit of practical techniques designed to cultivate emotional neutrality. The goal is not to become a robot devoid of feelings. The goal is to create a space between the emotion and your response, allowing your logical, disciplined mind to make the final decision. One of the most powerful techniques is to create a deliberate pause before every action. Before you click the buy or sell button, take one deep conscious breath. This simple act can break the hypnotic spell of the screen and interrupt the impulsive emotional reaction, giving your rational brain a moment to catch up. Another vital technique is visualization. Before the market even opens, spend a few minutes visualizing your trading day. See yourself executing your plan flawlessly. Imagine a trade going against you and hitting your stop loss. Feel the initial sting, but then visualize yourself calmly accepting the loss, logging it in your journal, and moving on without any emotional baggage. Then visualize a winning trade. See yourself letting it run to your predefined profit target and exiting mechanically without getting greedy. By mentally rehearsing these scenarios, you are pre-programming your mind to respond with discipline rather than emotion when these situations arise in real time. Physical environment and routine also play a massive role in emotional management. Trading from a chaotic, distracting environment will only amplify your internal chaos. Create a dedicated, organized workspace that promotes focus and calm. Develop a pre-market routine to get yourself into a peak mental state. This could include a short meditation, reviewing your trading plan and rules, or even light exercise. This routine acts as an anchor, grounding you in a state of professional readiness before you are exposed to the market's volatility. It signals to your brain that it is time to shift from your everyday emotional self to your disciplined trader persona. Finally, you must limit your screen time and avoid overanalysis once you are in a trade. Once your trade is placed, with its stop loss and profit target set, your job is mostly done. Constantly staring at the chart, watching every single tick up and down, is a form of self-torture. It only serves to heighten your anxiety and tempt you to tinker with your position. Set alerts for your key levels, your stop and your target, and then step away. Go for a walk, read a book, trust your plan. By physically removing yourself from the noise, you starve your emotional brain of the stimulus it needs to create fear and greed, allowing your initial logical plan to play out as intended. The ultimate strategy for managing emotions is to build a mental fortress so strong that fear and greed can barely find a crack to seep through. This fortress isn't built with affirmations or willpower alone. It's constructed brick by brick, with unwavering consistency and a deep, unshakable trust in your process. When you truly believe in your statistical edge over a large sample size of trades, the outcome of any individual trade becomes, well, increasingly irrelevant. This belief isn't born from blind faith. It's earned through meticulous preparation, testing, and the religious execution of your plan. Your trading plan is the blueprint for this fortress. As we've discussed, it must be objective, detailed, and written down. But it also has to be a plan that you've back-tested and have real confidence in. You must know, with statistical certainty, that if you follow these rules over the next 100 trades, you have a high probability of coming out ahead. This knowledge is your shield. When a losing streak occurs, which, honestly, it inevitably will, you won't be consumed by fear and doubt. Instead, you can look back at your data and remind yourself that this is a normal, expected part of your system's performance. It's a drawdown, not a disaster. Consistency is the mortar that holds the bricks of your fortress together. Every single time you follow your plan, regardless of the outcome, you add another layer of strength to your discipline. Conversely, every time you break a rule, even if you get lucky and it results in a win, you are chipping away at your own foundation, making it easier for emotion to take over next time. This is why we celebrate disciplined execution, not just profitable outcomes. Your focus must be on achieving a 100% success rate in following your rules. If you can do that, the profits will eventually take care of themselves as your statistical edge plays out. This shift in focus from outcomes to process is the most profound transformation a trader can make. It's really the final step in mastering your emotions. When your self-worth and emotional state are no longer tied to the profit and loss of your last trade, you are truly free. You're no longer a gambler on an emotional roller coaster, you're the manager of a probability-based business. You show up each day, execute your well-defined plan with discipline, manage your risk, and accept the results with equanimity. This is the path to emotional mastery. It's the way to trade not just for a living but with a sense of calm, control, and enduring confidence. We have now built a solid foundation of risk management. We've tamed our psychology, mastered our position sizing, and defined our exits with strategic stop losses. Now, we arrive at the reward for all this discipline. We get to witness the incredible, almost magical force of compounding. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. In trading, this principle is the key that unlocks true, sustainable wealth. It's the patient, methodical process of turning small, consistent gains into a fortune over time. It's the opposite of the get-rich-quick mentality that destroys so many accounts. Many traders are obsessed with hitting home runs. They dream of that one single trade that will double their account overnight. This desire, fueled by greed, leads them to take massive risks, which almost always ends in disaster. The professional trader understands a different kind of power. They know that the real path to significant wealth is not through giant leaps, but through a long series of small, steady steps forward. By focusing on making consistent, modest gains and, most importantly, protecting their capital from large drawdowns, they allow the quiet magic of compounding to work in their favor. It's a process that starts slowly, almost imperceptibly, but its effects accelerate dramatically over time. Think of it like building a snowball. You start with a small handful of snow. As you roll it, it picks up more snow, growing larger. The larger it gets, the more surface area it has, and the more snow it picks up with each revolution. Its growth becomes exponential. This is exactly how your trading account can grow when you apply disciplined risk management. Your first few winning trades might only add a small amount to your capital, but as your account grows, that same percentage gain now represents a larger dollar amount. The profits from one trade become the capital basis for the next, allowing your gains to build upon themselves in an ever-accelerating curve. This is why everything we've discussed so far is so critical. You can't harness the power of compounding if you're consistently suffering large losses. A single 50% loss requires a 100% gain just to get back to where you started, wiping out months or even years of progress. Our strict risk management rules, the 1% rule, the non-negotiable stop loss, are designed specifically to protect your capital and keep the compounding machine running smoothly. They ensure you avoid the catastrophic setbacks that would force your snowball to melt. Discipline is the fuel, and compounding is the engine that drives your long-term success. Compounding isn't just about your account balance, it's about your discipline and confidence as a trader. Every time you stick to your trading plan, you're making a deposit into your discipline account. Over time, these small acts become habits, building mental strength and resilience. This compounding discipline transforms uncertainty into confidence, even through losing streaks. The more you practice, the more automatic and ingrained your process becomes. As your discipline grows, so does your consistency and your results. This creates a powerful feedback loop. Discipline leads to better execution, which leads to better results, which reinforces your discipline. Each day is a chance to invest in your habits, not just your capital. Celebrate following your rules. You're building the foundation for long-term success. Remember, the true power of compounding is in the process, patiently applied over time. The habit that separates professionals from amateurs? Journaling every trade. Memory is unreliable, especially when money and ego are involved. A trading journal is your objective mirror, forcing you to confront the truth of your actions. It's your personal feedback loop, turning every trade into a lesson. Without it, you'll repeat mistakes and never truly improve. Like an athlete reviewing game footage, you must study your trades to spot patterns and weaknesses. Review your wins to reinforce good habits and dissect your losses to find the root cause. Are you following your plan or giving into emotion? This process transforms you from a passive participant into an active scientist of your own trading. The journal isn't for self-criticism, it's for self-improvement. Every entry accelerates your learning curve. Make journaling your most powerful tool for professional growth. What should you record in your journal? Go beyond entry and exit prices. Log the essentials: date, asset, position size, entry, exit, stop loss, and target. Add context. Why did you take the trade? Attach a chart and explain your reasoning. Record why you exited. Profit, stop, or emotion. Most importantly, note your mindset before, during, and after the trade. Emotional annotation reveals which feelings lead to discipline or mistakes. Grade yourself on execution, not outcome, and note what you'll do differently next time. This turns your journal into a dynamic playbook for growth. The market is always changing, a river, not a rock. Strategies that work today may fail tomorrow as conditions shift. Your job isn't to find a perfect system, but to become a master adapter. Don't react emotionally to every loss. Instead, review your strategy objectively and adjust as needed. Think like a ship's captain. Stay true to your course but adjust to the winds and currents. Sometimes you'll need to reduce risk or shift focus as volatility changes. Adaptation is about intelligent application, not abandoning your plan. Your journal is your logbook. Review it to spot when the market's current shifts. Use this data to make informed strategic adjustments. Stay in harmony with the market's rhythm, not fighting against it. Adapting requires a commitment to lifelong learning. The moment you think you know it all, you become vulnerable. True professionals are perpetual students, reading, studying, and expanding their skills. Structure your learning. Focus on one new concept or strategy at a time. Use your journal to identify weaknesses and set your learning agenda. Target your studies to address real data-driven gaps in your trading. This turns weaknesses into future strengths. Adaptation is a mindset. Humility, curiosity, and flexibility are key. By embracing continuous learning, you build the skills to thrive in any market. The most important trait for traders is a growth mindset. Unlike a fixed mindset which sees ability as unchangeable, a growth mindset believes skills can be developed. Traders with a fixed mindset see losses as proof they're not good enough, making them fragile and defensive. Growth-minded traders see losses as feedback and opportunities to improve. They embrace challenges, analyze mistakes, and believe effort leads to mastery. Cultivate this mindset by changing your internal dialogue. Ask, what can I learn from this? Every trading day becomes a stepping stone for growth. Mastery isn't a destination, it's a continuous process of becoming better. The journey of a trader is never a straight line upwards. It is filled with peaks and valleys, winning streaks and painful drawdowns. Setbacks are not a possibility, they are a certainty. How you handle these moments of difficulty is what will ultimately define your career. A growth mindset allows you to reframe these setbacks, seeing them not as failures that push you backward, but as essential stepping stones that propel you forward. Each mistake, each drawdown, and each period of poor performance contains a priceless lesson, but only if you have the courage and the right mindset to seek it out and learn from the experience that it provides. When you encounter a losing streak, a trader with a growth mindset asks powerful questions. They dive into their journal and their data, seeking to understand the root cause. Is the market environment changing, requiring an adaptation in strategy? Has a subtle flaw in my execution crept into my routine? Am I letting emotions influence my decisions? They approach the problem like a detective solving a case, gathering clues and analyzing evidence with detached curiosity. This process is not about self-flagellation. It is about problem solving. It transforms the pain of a drawdown into a catalyst for a breakthrough in understanding and skill. This resilience is built upon the disciplined foundation we have established throughout this masterclass. Your risk management rules are your safety net, ensuring that no single setback or losing streak can knock you out of the game entirely. They give you the financial runway to survive the learning process. By keeping your losses small and controlled, you give yourself the time and the psychological space to analyze what went wrong without panicking. This allows you to learn the lesson the market is trying to teach you, make the necessary adjustments, and return to trading with newfound wisdom and a refined approach that can help you succeed. Ultimately, bouncing back from setbacks is the true test of a professional trader. It is easy to be confident during a winning streak, but character is forged in adversity. By embracing a growth mindset, you learn to welcome these challenges as opportunities to prove your resilience and deepen your expertise. You understand that every scar tells a story and teaches a lesson. You begin to see your trading journey not as a quest for perfection, but as a journey of perpetual progress. This mindset ensures that no matter how many times you get knocked down, you will always get back up, stronger, smarter, and one step closer to achieving your goals. We have reached the end of our masterclass, but this is not a conclusion. It is a commencement. It is the beginning of your journey as a disciplined, professional risk manager. Throughout our time together, we have laid down the essential pillars of a successful trading career. We started by understanding the deep-seated psychology that governs our reactions to risk, recognizing the primal forces of fear and greed. We then armed ourselves with the practical, non-negotiable tools of survival. Meticulous position sizing and strategic stop-loss placement. These are the brakes and the seatbelt that ensure you can navigate the market safely and survive to trade another day, which is the first and most important victory. We journeyed further, into the very heart of the trader's challenge managing emotions. We learned techniques to remain calm and objective amidst the market's chaos, building a fortress of discipline brick by brick. With our defenses secure, we explored the incredible quiet power of compounding, seeing how small consistent gains protected by smart risk management can grow into substantial wealth over time. We uncovered the transformative power of a trading journal, your personal mirror for self-reflection and continuous improvement. It is the tool that turns every trade, win or lose, into a priceless lesson, ensuring that you are always moving forward on your path. We discussed the necessity of adaptation, recognizing that the market is a constantly flowing river, not a static rock. This requires a commitment to lifelong learning and the flexibility to evolve your strategies as conditions change. Finally, we cemented this entire framework with the foundational power of a growth mindset. This is the belief that you are not defined by your current results, but by your capacity to learn, adapt, and grow from every experience. It is the resilience that allows you to embrace setbacks not as failures, but as the very stepping stones that lead to mastery. Each of these chapters is a thread, and you now hold them all in your hands. Now it is time to weave these threads together into the tapestry of your trading career. The path ahead will not always be easy. There will be challenges. There will be moments of doubt. But you are no longer navigating blindly. You now possess a map and a compass. You have a framework built on principles that have stood the test of time, a system for managing not just the market's risk, but the far greater risk that lies within yourself. Look at this moment as the sunrise on your new trading life. The darkness of uncertainty and emotional decision-making is receding, replaced by the light of clarity, process, and unwavering discipline. The principles we have shared are powerful, but they are only potential energy until you put them into practice. True mastery is forged in the fires of daily application. It is born from the commitment you make to yourself right now to show up each day and execute your plan with the focus and discipline of a professional. This is your personal invitation to step up from being a market participant to becoming a market master. It is a call to leave behind the gambler's mindset of hope and luck, and to embrace the business owner's mindset of process, probability, and meticulous risk management. The choice to walk this path is yours alone to make. This journey of self-mastery can feel lonely, but it does not have to be. The ethos of prophetic analysis is built on community and shared growth. We believe that we are stronger together. By joining our community, you connect with fellow traders who are walking the same path, facing the same challenges, and striving for the same level of professional excellence. It is a place to share insights, ask questions, and hold each other accountable. It is a space where the principles of this masterclass are lived out every single day. We are here to support you every step of the way as you build your future. Remember the core truth we began with. Trading isn't about beating the market, it's about mastering yourself. This is the ultimate challenge and the greatest reward. The financial gains are simply a byproduct of this profound inner work. The real prize is the person you become in the process. Disciplined, resilient, patient, and objective. These are qualities that will not only serve you in the markets, but will enrich every area of your life. This is the true wealth that a trading career pursued with the right mindset and principles can offer to you. It is a journey of personal transformation. The sun is rising on a new day and a new way to approach the markets, a way forward built not on hype, but on substance, not on secrets, but on sound principles, not on beating others, but on mastering ourselves. This is our vision for the future of trading, and we invite you to be a part of it. Take what you have learned, apply it with diligence, and never stop growing. The path is clear. The tools are in your hands. Join us. Let's shape a new way forward, together.